Have you ever sat across from a car salesman who's furiously tapping numbers into a calculator, only to look up with a big smile and say, "Great news, I got your payment down to $650 a month." And in that moment, instead of feeling relieved, you feel this weird mix of excitement and dread because you know $650 is still a lot of money, but somehow it feels like a victory because 5 minutes ago they were talking about $900. Yeah, that feeling right there, that's the exact moment millions of Americans get trapped in what I call the 7-year loan nightmare. And here's the really messed up part. You walk out of that dealership feeling like you won the negotiation, when in reality, you just signed up to pay potentially $55,000 for a $35,000 car.
My name is Clint, and I spend way too much time thinking about why car payments have become the single biggest wealth destroyer for middle-class Americans. If you're someone who's ever looked at your bank account and wondered why you're always broke despite having a decent job, or if you're currently making a car payment that feels like it's slowly suffocating your financial future, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today, we're going to break down exactly how the automotive industry has convinced an entire generation that paying $700, $800, even $1,000 a month for a depreciating asset is somehow normal. And more importantly, I'm going to show you the real math behind these 7-year loans that dealerships conveniently forget to mention. 1. The scale of the problem. Let's start with some numbers that should honestly make you angry. According to recent data from Experian, the average monthly payment for a new car in America is now $739. For new trucks and SUVs, which make up the majority of vehicles sold today, that number jumps to over $800. But here's what most people don't realize. That's not a historically normal number. In 2010, the average new car payment was around $465. So in just over a decade, car payments have increased by nearly 60%. Now, you might be thinking, well, Clint, inflation is a thing. Maybe cars just cost more now. And yeah, cars do cost more. But wages haven't increased by 60% in that same time period. The median household income has grown by maybe 25–30%, depending on how you measure it. So we've got car payments growing twice as fast as wages. That math doesn't math, as the kids say. Here's where it gets really interesting. Despite these astronomical payment increases, Americans are buying more expensive vehicles than ever before. The average new car transaction price is now over $48,000. $48,000! That's more than the median household income in several states. People are literally buying vehicles that cost more than what half the households in their state earn in an entire year. How is this possible? How are regular people, teachers, nurses, retail managers, office workers, affording to drop $750 a month on a vehicle? The answer is both simple and terrifying. They're not actually affording it. They're just stretching the pain out over so many years that the monthly number looks manageable. Welcome to the 7-year loan trap. 2. The mechanics of the trap. Look, I need you to understand how fundamentally the car-buying landscape has changed. A generation ago, a car loan was typically 36 months, 3 years. You bought a car, you paid it off in 3 years, and then you drove it for another 5–10 years without a payment. That was the normal cycle. Today, according to Experian, the average loan term for a new car is 68 months. That's 5 years and 8 months. But here's the kicker. That's just the average. A huge percentage of loans now extend to 72 months, 6 years, 84 months, 7 years, and I've even seen 96-month loans, which is 8 years. Some lenders are now offering 120-month loans. That's 10 years. You could literally finance a car when your kid is in 3rd grade and still be making payments when they graduate high school. The appeal is obvious, right? If you take that $48,000 vehicle and finance it over 4 years at 7% interest, your monthly payment is going to be around $1,150. That's a lot. That's mortgage money for many people. But if you stretch that same loan over 7 years, suddenly the payment drops to around $700. Same car, same interest rate, but the monthly number just became affordable. Except here's what the finance manager sliding those papers across the desk isn't telling you. By extending that loan from 4 years to 7 years, you're going to pay an additional $6,800 in interest. You're paying almost $7,000 extra just to make the monthly number look prettier. Let me put that in perspective. $6,800 could be a fully funded emergency fund for most people, a significant down payment on a home, a year's worth of IRA contributions, 2 really nice vacations with your family, or, $6,800 that you could literally just keep in your bank account instead of giving it to a lender. But the extra interest is actually the least of your problems with these extended loans.
The depreciation disaster. Here's the thing about cars that everyone knows intellectually, but nobody actually factors into their decision. They lose value. Fast. Like shockingly fast. The second you drive that new vehicle off the lot, it loses about 10 to 20% of its value. In the first year alone, a new car will typically depreciate by 20 to 30%. By year 3, that $48,000 vehicle you bought is probably worth around $30,000. By year 5, you're looking at maybe $22,000 if you're lucky. Now, here's where the 7-year loan trap really shows its teeth. Let's run the actual numbers on that $48,000 vehicle financed over 84 months at 7% interest. After 12 months of payments, you've paid down about $6,000 of principal, but your car has depreciated by $12,000. You're already $6,000 underwater. After 36 months, you've paid down about $18,000 of principal. Your car is now worth about $30,000. You still owe around $30,000. You're break-even at best, assuming the car depreciated slower than average. After 48 months, you've paid down maybe $24,000. Your car is worth $25,000. Great, you're finally above water. Except you still have 3 more years of payments to go. This is what I call the underwater period, and for people with 7-year loans, they're typically underwater for the first 4 to 5 years of ownership. That means if anything happens, you lose your job, you need to move, the car gets totaled, your family situation changes, you can't get out of the loan without writing a check for thousands of dollars. You're trapped, and that's not an accident. That's the design.
The trade-in treadmill. Now, you might be thinking, okay, Clint, but if I just keep the car for the full 7 years and pay it off, then I'm fine, right? I'll own it free and clear. And theoretically, yes, if you could actually keep a car for 7 years without wanting something new, you'd eventually escape the trap. But here's what the data shows. The average person keeps a new car for only about 6.5 years, and many people trade in or sell even earlier, especially if they took out a long loan. Here's how the treadmill works in real life. Year 1 through 3, you're excited about your new truck. It's got that new car smell, all the latest features, everything works perfectly. Year 4, you start seeing newer models with better technology. Your infotainment system feels outdated, maybe you had a minor accident and there's a dent you never fixed. The initial excitement has worn off. Year 5, your coworker just bought the latest model of your truck, and wow, it looks amazing. The new safety features, the updated interior, that sleek redesign. Suddenly, your truck feels old, even though you still owe $15,000 on it. So what do? You go back to the dealership just to look, and the salesperson runs the numbers. Good news, they say, we can get you into that brand new model for only $50 more per month. We'll just roll your negative equity into the new loan. And just like that, you're signing up for another 7-year loan. Except now, you're not just financing the new truck, you're also financing the $5,000 you still owed on your old truck. You're paying for 2 trucks, but you only get to drive 1. This is how people end up owing $65,000 on a truck that costs $52,000, and the cycle continues. Every few years, they trade in while underwater, roll the negative equity into a new loan, extend the terms to keep the payment manageable, and dig themselves deeper and deeper into automotive debt. I've seen people who are on their third or fourth vehicle in a decade and have never once been without a car payment. They've paid hundreds of thousands in car payments over their adult lives and have nothing to show for it. No wealth, no assets, just an endless parade of depreciating vehicles and the privilege of driving something that looks nice for a few years before the cycle repeats.
So now you're stuck on this treadmill, trading in every few years, rolling negative equity into bigger and bigger loans, never actually owning anything outright. But here's the question nobody asks. Why do people keep doing this? Why do intelligent, hard-working people voluntarily sign up for this cycle over and over again? The answer isn't what you think. And once you understand the psychology behind it, the emotional triggers that dealerships exploit, you'll never look at a car commercial the same way again. In Part 2, I'm going to expose the psychological manipulation tactics that keep millions of Americans trapped in car payments for their entire lives. Then I'm going to show you the real numbers, the actual wealth you're sacrificing, and give you the exact escape plan. If you don't want to miss Part 2, hit that subscribe button right now, because what I'm about to reveal might make you angry, but it could also save you hundreds of thousands of dollars. I'll see you there.